Hello to all value investors, welcome back to valuesnip.com. In today's video, we will show you what to look for in the balance sheet and the cash flow statement according to her book The Interpretation of the Financial Statement. Under the balance sheet, we will find two main categories. One is the assets of the company and the other is liabilities. In both of these categories, there are short-term and long-term liability or current and non-current assets. For the short-term, liability is debt that is due within a year, and for the long-term, liability is debt that is due over a year. For current asset is any possession that the company can easily liquidate to extract cash within the year. And non-current asset is any asset that is not easily liquidated. This usually takes more than a year to extract any value of cash. In order for us to get the net worth of the company, we must subtract the total assets to total liabilities, then we will get the net worth of the company. In other words, shareholders' equity is the same as the net worth of a company. If we zoom this down on a personal level, we would want ourselves to have a positive net worth instead of a negative net worth. Therefore, when we look at the company's net worth, it will be wise to select those that have a positive net worth as well. Here are a few keys to look for when looking at the balance sheet. 1. Cash equivalent section. If there is any in this tab, we would like to see the number piling up from year to year is a good sign. When it piles up, this means that the company is generating a lot of cash. One-time piling up is a sign that the company sold part of their business or bonds, and this is a bad thing, something to pay attention to. A rule of thumb for this section: if a company is sitting on a lot of cash and barely any debt, is usually a good sign that this company has some sort of competitive advantage. However, if the company is short on cash and is in a lot of debt, this is what we should avoid. 2. Receivables section. When looking under this tab, we would like to take the net receivable and compare it with the gross sale. Make sure this number is lower than the gross sale. A gross sale is a number that reflects the grand total of all the sale transactions within a certain period for the company. And, to get the net receivable, we would have to take the total receivable amount and minus with the allowance for doubtful accounts. As you can see here from this illustration, allowance for doubtful accounts is bad debt that we don't think the client will pay us back. When minus bad debt with the total account receivable, we should get net receivable. Please note it is very difficult to find the gross sale of the company, so in this case, we should use net sales, also referred to as total revenue of the company instead. 3. Inventory. We already cover this section in another video. This section is very important and we will leave the video on the end screen. Thank you. 4. Current assets can be used to get the current ratio. A current ratio equal to current assets divided by current liabilities, and anything below 1 is something to be careful with. Anything above 1 is good, but the range should be 1 to 2. However, some companies with a very good competitive advantage could be below 1. If this is the case, make sure we look at their net income or earnings to see if the company is in good health. 5. When looking at goodwill, we see it increase year over year. This means that the company is acquiring other businesses. This can be a good thing if the company is purchasing competitive advantage companies. 6. When looking at long-term debt or liability, little or no long-term debt is a good sign that the company has some sort of competitive advantage. The rule of thumb is little or no long-term debt is a good long-term bet. 7. Short-term debt. Be careful with companies that borrow a huge sum. We would recommend investors be careful with companies that have more current liability than their current assets. 8. Long-term investment is carried on the asset side of the balance sheet. This number can reflect management thinking. Are they investing with the capital that is generated by the company? If they are, and if they invest in other companies with a competitive advantage, this is a good sign. 9. Preferred stocks is usually a sign that the company is not in a competitive advantage arena, because great companies do not need to finance more capital since they are already generating so much capital. If any company that preferred stock, watch out for. 10. Retained earnings is an accumulated number. When a company generates profit, this profit reflects in the retained earnings and growing year over year. If the company loses money, then it will reflect in the retained earnings as negative or in brackets. Only rare occasions where retained earnings are negative in a competitive advantage company. Please remember, this is one of the most important sections in the balance sheet. If the retained earning is not growing, then their net worth is not growing, and if that is the case, it won't get us far with our investment. 11. Treasury stock. When looking at this tab, it will show us that the company is repurchasing their share, which is a good sign. However, there can be financial engineering in some cases. 12. Return of shareholders' equity. Mr. Warren usually prefers 30% or more. Net earnings or net revenue divided by shareholders' equity will give us this percentage. Rule of thumb is to be careful with a company that shows both negative in shareholders' equity and net earnings or net revenue. Now we will move on to the cash flow statement, but before we do that, if you like what you are seeing so far, may you kindly click that like button. This will really help us a lot, and we truly owe it all to you. Thank you. 1. Capital expenditure. As mentioned earlier, not having it is always a good sign. As a rule of thumb, a company that used less of their earnings on capital expenditure is better than those that have a huge sum of their earnings in this tab. Net earnings or net revenue of 50% or less go to capital expenditure is usually good companies with a competitive advantage. Track this history through 5 years to 10 years records. 2. Stock buyback. We can find this under cash from the cash flow from continuing financing and under net common stock issuance if you are using Yahoo Finance. If you are using MSN Money, it will be under cash flow from investing activities and under the proceeds or issuance of common stocks. Stock buyback is a great sign that a company is doing very well and they are buying back their share. When a company does this, it helps to raise the price of the stock, making it worth more. 3. Free cash flow is very important for this number. It should be positive and grow year over year with competitive advantage companies. This number reflects the cash that is generated after all operating expenses and capital expenditures are covered. According to Mr. Peter Lynch, free cash flow is the most important number to look for when looking at the cash flow statement.